Welcome back, Smarties, to another episode of Smart Real Estate with Westcliff. I'm Addy Saeed, here with my good friend and co-host, Kaz Joffer. This is Series 7, Engaging Expert Insights, and today we're jumping into one of the most crucial parts of real estate investing, the financial side.
That's right. From how you finance a deal, to understanding your return, to how taxes impact your bottom line, we're pulling back the curtain on the numbers that drive good investment decisions.
We'll cover real-world structures that we use with our investors, show you how to spot strong returns, and explain why a financing plan can make or break your strategy.
Let's start with how most real estate projects are funded, the capital stack. You'll typically see a combination of senior debt, usually from a bank, preferred equity or mezzanine debt, which is a bridge layer of capital, and finally, common equity. This is where you, the investor, often come in.
At Westcliff, we help investors plug into the stack at a level that fits their goal. Want priority returns? You might be in pref equity or preferred equity. Want upside? You might be in common equity with a share of the profits.
And we use tools like vendor takebacks, bridge loans, and CMHC financing to get creative and drive performance.
Let's demystify one of the most important terms, IRR, internal rate of return. It's a fancy way of saying what's the time-weighted return on your investment over the life of the deal.
Then there's cash on cash return. How much cash you're earning annually relative to what you've invested. For example, if you put in $100,000 and earn an $8,000 annual distribution or dividend, that's an 8% cash on cash return.
We also talk a lot about equity multiple. For example, a 2.0x multiple means double your money over the course of the investment. It's simple, but it matters, especially for long-term plays.
Taxes are where many investors leave money on the table. At Westcliff, we work with structures that optimize for tax efficiency using return of capital, capital gains, and flow through entities.
We also work with registered accounts like RRSPs, TFSA, LIRA, even RESPs through our exempt market dealer partnerships. This allows investors to earn tax-deferred returns or tax-free depending on the account they're using.
If you're holding a real estate in a corporation, there are additional strategies we can layer in, including active versus passive income planning, capital dividend accounts, and more.
Let's walk through an example. A 40-unit apartment building using CMHC financing at 85% loan to value. Investor provided the remaining 15% through a GP-LP structure.
The project offered a 6% preferred return and a 70-30 split above that. This projected a 16% IRR over 5 years, with strong upside because of planned rent repositioning.
Because of a CMHC insured loan, the financing rate was under 4.5%, a key driver in positive leverage. That's the kind of opportunity that a well-structured financial plan unlocks. If the numbers excite you, but you want help interpreting them or building a plan that works for you, book a strategy session at cal.westcliffam.com. We'll break it down for you according to your goals.
If you haven't already, join the Westcliff Investors Network at win.westcliffam.com. You'll get early access to new offerings and breakdowns of the financials before anyone else.
Our mission at Westcliff is to help you learn, invest, and manage, and mastering the financial is a big part of that. And remember, this podcast is for educational purposes only. Please consult a licensed advisor before making any investment decisions.
Next episode, we're tackling the flip side of returns, risk management strategies, what can go wrong, and how we protect investors when it does. See you then.
Happy investing.